The explosive surge in the crypto market following the latest Federal Reserve announcement was not the result of a dramatic policy shift or a charismatic speech. Instead, it was catalyzed by a subtler, more powerful force, strategic silence, and a single definitive conclusion. This move can be best understood as the Fed's silent nod, a tacit approval that unlocked a floodgate of pent-up institutional liquidity and reshorted market psychology in a single session. At the heart of this reaction was the Fed's official confirmation that quantitative tightening, QT, has ended. To appreciate the magnitude of this, we must move beyond the jargon. QT is the process by which the Fed reduces its massive balance sheet, effectively pulling money out of the financial system's bloodstream. It is the opposite of the money-printing quantitative easing, key, that characterized the last decade. For months, this silent runoff acted as a constant gravitational pull against risk assets like crypto. Its continuation was a looming what-if that kept many large, cautious capital allocators on the sidelines. By definitively announcing the end of QT, Chair Powell didn't just change a policy. He removed a fundamental uncertainty. He signaled that the period of maximum monetary contraction is over. The spigot isn't gushing yet, but the hands are no longer tightening the valve. For institutional traders and algorithmic funds, this wasn't just data. It was a clear binary signal. A major variable in their complex risk models shifted from ongoing constraint to constraint removed, triggering automated and strategic buys. This leads to the second critical component, what Powell didn't say. The market had braced for potential hawkishness, hints of renewed vigilance on inflation, or a pushback against imminent rate cuts. Powell offered none of that. He delivered a masterclass in neutrality, avoiding forward guidance on the economy or the timing of the first cut. In a high-stakes environment where every word is parsed, this silence was profoundly bullish. Why? Because in the face of uncertainty, the market consistently fears hawkish surprises more than it hopes for dovish ones. A nothing announcement was decisively better than a bad something announcement. It was interpreted not as indecision, but as permission. The message read by traders was, the path to easing is now clear of immediate obstacles. We are in a holding pattern, not a reversal. The market's violent reaction, epitomized by the liquidation of over $140 million in short positions in 1 hour, was a classic sell the rumor by the news play, but with a crucial twist. The rumor phase was dominated by fear and hesitation. The news was the removal of that fear. This created a powerful vacuum effect. As leveraged short bets were violently unwound, their forced buying amplified the upward move, drawing in momentum traders and FOMO-driven capital. This wasn't just about the Fed being good for crypto. It was about the Fed ceasing to be an active bank. The rally was, at its core, a relief valve being released. The strategic implication of this silent nod cannot be overstated. It represents a critical phase transition in the macroeconomic backdrop for digital assets. We have moved from a regime defined by fighting inflation through constriction to a new regime of managing the aftermath and preparing for stimulation. This transitional phase is where liquidity begins to reaccumulate at the margins, where risk appetites tentatively expand, and where assets most sensitive to liquidity, like cryptocurrency, find their first solid footing. The Fed didn't spark the rally with a new catalyst. It did so by taking its foot off the brake. The car wasn't yet accelerated, but the sudden lack of resistance was enough to let it roll forward with surprising momentum down the hill of market sentiment. Therefore, this is more than a short-term pump. It is a psychological and structural reset. The market's number one macroeconomic headwind has been officially retired from active duty. This grants a new baseline from which all future data, CPI reports, job numbers will be judged. The question is no longer, will they ever stop tightening? That has been answered. The trillion-dollar question has now cleanly shifted to, when will they begin to ease? By answering the first, the Fed has allowed the entire market, from Bitcoin miners to Wall Street portfolio managers, to finally, and with full focus, start pricing in the answer to the second. This shift in questioning alone unleashes a wave of strategic repositioning that will drive volatility and opportunity for months to come. The silent nod was the starting pistol. The race to price in the next liquidity wave has now officially begun. The crypto landscape has long been characterized by a predictable divide: the evangelists and builders within the ecosystem versus the skeptical, often dismissive, legacy institutions of Wall Street. That era is conclusively over. The most significant and actionable signal for the current market is not found on a blockchain explorer or in a developer's Discord, but within the conservative, risk-averse halls of traditional finance. The pivotal moment is Bank of America's formal advisory to its clientele to allocate up to 4% of their portfolios to digital asset. This is not a niche analyst report or a speculative funds thesis. It is a strategic directive from one of the world's largest and most systemically important custodian banks. This move represents a seismic shift from passive observation to active facilitation, acting as a master key designed to unlock trillions in dormant, institutionally managed capital. To understand the magnitude, one must grasp the psychology of institutional capital. Billions are managed under strict mandates, compliance frameworks, and fiduciary duties that prioritize precedent and the imprimatur of established authority. For a senior portfolio manager at a pension fund or a family office, buying Bitcoin based on a YouTube analyst chart was not just risky, it was career-ending. They required cover. They needed a recognizable, credible authority within their own ecosystem to validate the asset class, to provide the necessary language for investment committee memos, and to establish a reasonable benchmark for allocation. Bank of America, with its vast retail and institutional network, has now provided that cover. Their 4% is not a price target. It is a psychological and procedural benchmark. It transforms crypto from a speculative bet into a strategic diversifier in the official lexicon of finance. The unspoken message to every financial advisor under their umbrella is clear. Discussing this allocation is now part of your duty of care. This formal endorsement triggers a cascading effect. If the conservative banks say 4%, what is the implied allocation for more aggressive hedge funds, venture-backed family offices, or sovereign wealth funds? The logical answer is 6. This isn't mere adoption. It's the institutionalization of allocation thresholds, creating a predictable incoming flow of capital measured in the hundreds of billions. However, this profound integration creates a new market paradigm defined by a double-edged sword. The very instruments facilitating this influx, the spot Bitcoin ETF, the publicly traded crypto treasury companies like MicroStrategy, have fundamentally altered market mechanics. They act not just as on-ramps, but as volatility amplifiers and systemic connectors. On the way up, they are rocket fuel. Inflow into an ETF requires the issuer to purchase the underlying asset, creating a reflexive, self-reinforcing by pressure. But this mechanism works in reverse, with terrifying symmetry. Sustained outflows force liquidations, driving price down, which can trigger margin calls on over-leveraged balance sheets at public crypto companies, forcing them to sell assets to cover debts, driving prices down further. This creates the potential for a modern, tech-driven volatility doom loop. The market is no longer just a battle between retail bulls and bears. It is a complex, interconnected system where traditional capital flows directly influence on-chain liquidity and the solvency of major crypto-native entities. The Silicon Valley investors' recent public skepticism of high-leverage strategies underscores that this new fragility is being scrutinized at the highest levels of traditional finance. This new era also marks the final blurring of the line between crypto market and macro market. When BlackRock's ETF trades billions in volume within hours of a Fed announcement, or when Vanguard's policy shift moves markets, crypto ceases to be an isolated asset class. It becomes a high-beta, highly liquid expression of global macro sentiment, particularly around liquidity expectations and dollar strength. The price action is no longer driven solely by Bitcoin halvings or Ethereum upgrades, but by the same Fed statements, CPI prints, and Treasury auctions that move the NASDAQ or the dollar index. This integration means crypto gains a more stable long-term demand profile from diversified portfolios, but loses its insulation from traditional financial shocks. Ultimately, the signal from Bank of America is the culmination of a decade-long infrastructure build. It was made possible by regulated futures, then spot ETF, then clearer, if imperfect, accounting standards. The bank is not leading the charge. It is validating the bridge that has already been built. Its recommendation is a declaration that the bridge is now deemed safe for the heaviest, slowest moving capital. The strategic implication for every investor is profound. The primary driver of the next major bull phase may not be retail FOMO, but the methodical, mandate-driven rebalancing of the world's largest portfolios. This capital is slow to move, but inexorable in its direction and staggering in its scale. The game has changed from predicting the next viral meme coin to understanding the quarterly investment committee cycles of the world's largest asset managers. The banks are no longer the skeptics. They have become the signal, and their entry marks the true beginning of crypto's maturity as a mainstream financial asset. The volatility will be greater, the systemic linkages more critical, but the capital floor has been permanently and dramatically raised. The instinctive and often lazy comparison for any period of rapid technological valuation expansion is the dot-com bubble of the late 1990s. While the echoes, breakneck investment, mainstream fascination, and soaring valuations are undeniable, this analogy is dangerously incomplete. To mistake the current moment for a bubble is to fundamentally misdiagnose its nature and potential longevity. We are not witnessing a speculative frenzy built on static web pages and ethereal eyeballs. We are living through a parallel build era, characterized by the simultaneous, tangible construction of utility and infrastructure in two foundational domains: artificial intelligence and cryptocurrency. This period is further underpinned by a powerful and often overlooked macroeconomic thesis: the structural extension of the traditional business cycle, which provides this build phase with a far longer and more stable runway than historical parallels would suggest. The dot-com build framing is critical. The late 90s bubble was largely a capital phenomenon chasing a consumption and advertising model. Today's landscape is defined by capital chasing foundational production. It gives traditional institutions the operational time frame they need to complete their cumbersome but monumental onboarding processes. In essence, the macro debt management of the past has inadvertently bought the build era the time it needs to graduate from promise to pervasive reality. The strategic imperative is no longer to guess the short-term top, but to ensure one's capital is allocated to the foundational layers of this new digital economy, with the understanding that the phase of maximum construction and the associated capital flows and volatility has been granted a longer, more stable mandate by the very structure of the global financial system. We are not at the end of a bubble. We are in the early, most pivotal chapters of a new economic volume, and the library has just informed us the due date has been pushed back.